we're going to wind up Chapter 1 with a discussion of basically some exceptions to the standard deduction issue for certain kinds of filers, and then we're going to move into a discussion, or I guess an introduction of capital gains. So here we go. This table you saw in the earlier videos. This is the table with the standard deduction based on filing status. And so for those who are not itemizing, this is basically what they take as their standard deduction. In addition, there are some deductions, or excuse me, additions to the standard deduction for people who are blind or over 65. But there are some individuals who are not eligible for the standard deduction. And so if there are situations where you've got married spouses who are filing separately and one spouse itemizes, the other spouse must itemize as well. Well, this can be particularly unfortunate. If we think back in the beginning to our example of Bill, who had a choice of taking $6,500 in itemized deductions or his standard deduction of $12,200. Now let's say Bill was in fact married and had a spouse that was filing separately, and that spouse had substantial itemized deductions. Bill would then be forced to use his itemized deductions of $6,500 rather than his much larger and more favorable standard deduction. And that would result in Bill probably owing some taxes unless he withheld appropriately in anticipation of that. So that is one of those little caveats when you've got spouses that are filing separately. Somebody who is a non-resident alien must or may not use the standard deduction. Anyone who is filing a short period tax return. Generally, a tax return is a calendar year, January 1 to December 31. There may be some instances where it is favorable and appropriate to elect a short tax year. And if that's the case, then the individual electing the short tax year is not eligible for the standard deductions. And then we talked about dependents early on. So if you've got a child who is a dependent, and mom and dad are claiming them as a dependent on their tax return, but the child has significant earnings and the child has to file a return, what does the child get to take for a standard deduction? Well, the child can't take that $12,200 that would otherwise be available to a single taxpayer. What is established that the child may take as a standard deduction when somebody else is claiming them as a dependent is that their standard deduction cannot exceed the greater of $1,100 or the sum of $350 plus the dependent's earned income and up to the basic standard deduction of $12,200. What in the world does that mean? I'm glad you asked. So here we have an example of 8-year-old Penzer, and poor Penzer is going to have to live with that name. So let's hope that the tax laws treat him more favorably. Penzer earned, he's quite an industrious 8-year-old, $17,000 in 2019. Not sure what Penzer did, but more power to Penzer for being industrious. And his parents claim him as a dependent on their taxes. Does Penzer have to file a tax return, and if so, how much is his taxable income? Well, we've this here. So Penzer is required to file a tax return. His taxable income will be $4,800. How do we make that determination? So we've got earned income minus the standard deduction. Well, wait a minute. You just told me that standard deduction of $12,200, if he's a dependent, he can't take that. Well, that's the most he can take. So remember, we've got the standard deduction is the greater of 1,100 or 350 plus the dependent's earned income. So Penzer's earned income was 17,000. So 17,350 is our working number, but it's capped at the standard deduction. So in this case, because of Penzer's earnings, he is limited to the amount of the standard deduction. And so we subtract 17,000, his gross earnings, or we subtract the standard deduction from that because it is capped at that, and he has taxable income of $4,800. Now, look at this scenario. What if Penzer had only earned 9,000? So he gets the greater deduction of either 1,100 or his earned income plus $350. So in this case, we take his earned income of 9,000, add 350 to it, and his standard deduction is the greater of 1,100 or 9,350. And so Penzer's standard deduction at this point would be 9,350. And because his standard deduction exceeds his hypothetical earnings here of 9,000, he doesn't owe any tax, nor is he required to file a return. Now let's contrast that with Jeffrey. Now Jeffrey's 4, and he's claimed as a dependent by his parents, rightfully so. He earned $6,500 in interest income from a large bank account left to him by his grandmother. Go Jeffrey. So how much is taxable? Well, remember that 1,100 or 350 plus earned income plus earnings is the test. Does Jeffrey have earnings? Well, this came from interest income from a bank account. Jeffrey just had to wake up every morning to receive this money. He didn't actually have to perform services or do anything to get it. So he didn't, it is not considered earnings. So therefore that 350 plus earnings, he's got no earnings. So Jeffrey's standard deduction is capped at the 1,100 because there is no earnings. So we take his $6,500 in interest income, we subtract the $1,100 standard deduction that he's entitled to, and his taxable income is $5,400. And we would then go to the tax tables with that and figure out how much tax Jeffrey's got to pay on his $5,400. So, and I know that this is kind of a confusing topic. Any questions on this, please post them on the general discussion board. Happy to have a group chat about that there. We're going to kind of take a left turn here and move away from filing status to a different kind of income. Thus far, for the most part, we've been talking about earnings, and we had a little bit of interest income here. There is another kind of income that, and I should say loss as well, that is different from services that someone may perform. It is when we sell an asset at a gain or loss, and that has different tax treatment than if we earned money. So how do we determine what the gain or loss is? Well, we look at the amount realized. What is that? That's what we sold it for. So if we sold something, if we had a car and we sold that car for $2,000, the amount realized was $2,000. Now, if we had to pay a commission to somebody to sell the car for us, maybe we deduct the cost of the commission. But, if this is your standard, just I'm selling you something, then the amount realized is $2,000 in my little example, minus the adjusted basis. So the adjusted basis is going to be the cost minus any accumulated depreciation. So what we paid for it and then we're going to deduct any depreciation that we took along the way. If the amount we realized is more than the adjusted basis, then we have a gain. If the amount we realized is less than the adjusted basis, then we have a loss. And generally, gains and losses are also recognized and included in the taxpayer's income. Now, I don't want you to get too hung up on the capital gains and losses issue at this point, because this is something that we're going to devote much more extensive time to later on in the term. This is really just an exposure to the concept. But capital gains and losses are generated when we sell a capital asset. Well, what's a capital asset? Stocks, bonds, it could be something large and physical, land, cars, boats, investment property, things like that. And we separate that out from, gross income from earnings because we treat it differently. And part of the way that we treat it differently depends on how long we held the item before we sold it. So if we held the item for less than 12 months, then we actually treat that gets taxed at the same tax rate as our other earnings. On the other hand, if we've held this asset for more than 12 months, then we get a more favorable tax rate that is applied to that capital gain. We may also be able to deduct a capital loss, but we have a limit on how much loss that we can deduct, because we can't let a massive loss wipe out all of our earnings, for example, and say, oh, I had this big loss and that basically erased all of my income, so I owe no tax this year. Let me have my refund, please. So what they said is, no, we're going to let you only take a $3,000 per year loss against your ordinary earnings. And so what if the loss is $10,000? Well, you can take $3,000 this year, you can take $3,000 next year, you can take $3,000, and so you can continue to roll forward at the rate of $3,000 a year until you run out. And so, if the loss was 10,000, you take 3 this year, 3 the next year, 3 the following year, and the year after that you have a 1,000 left, and then you've used up your $10,000 loss. Now, I'm actually only going to just go through this briefly. Like I said, I think this is better addressed in the chapter where we actually dive into this a little bit more, but because there may be some homework related to this, I will talk about this here a little bit more. So we've got Erin, who purchased some stock. And if you've not purchased some stock, there are apps now that make it really easy for individuals without paying huge brokerage fees to dip their toe in the stock market. So, Robinhood is a particularly popular app that a number of my students have used and report to me about, that they find as being an easy way for them to make an entry into the stock market without having to pay fees or have any sort of major commitment. So I'm finding that more and more of my students now actually are buying and selling stock. And so these things become a little bit more relevant for them. So we've got Erin, who purchased some stock in JKL Corporation several years ago. That should tell you something. Oh, several years. She's had it for several years, more than 12 months. So we're looking at long term. She spent $8,750 on it. In the current year, now she sold it for $12,800. She paid a $200 commission to her broker. And so how much did she realize? Well, the amount she realized is $12,800 less the selling expense. So try and do this again. So she realized 12,600. What is Erin's adjusted basis? Well, Erin, this is not an asset that has been subject to depreciation, so we don't have any accumulated depreciation, and so her cost was $8,750. So what is Erin's realized gain or loss? So 12,600 minus 8,750, it gets us to 3,850. This is terrible. Okay. What is Erin's recognized gain or loss? And I shut off the drawing thing here because it was a little irritating. But basically, the 3,850 is what Erin is going to recognize as her capital gain on the sale of this. And as I said when I read it earlier, how is a gain treated, it is going to be treated as a long term. So it's going to get a more favorable rate. If she had held it for less than 12 months, it would be taxed at the same tax rate as her regular earnings from her job. But because she's held it for long term, it's going to get a more favorable rate. Now, what that more favorable rate is will be determined by what other income she has in terms of what. So there are three different capital gains rates. There's 0, a 15%, or a 20%. And whether she pays a 0 capital gains rate, a 15%, or a 20% will depend, again, on what other earnings she has, and that will determine which one of those rates applies to her. But you can see that potentially if she's low enough income, she might pay 0 income on that $3,850. So not bad. And this is why often people want to make sure that they hold that investment for longer than 12 months so that they can get the benefit of that more favorable capital gains rate. And then just last couple things. There are lots of resources on the IRS website, plenty of user information there. You can check refunds, you can make payments on there. The IRS, believe it or not, has a YouTube channel with a number of videos. So if these weren't scintillating enough for you, you can certainly check out the IRS's YouTube channel. There are iTunes podcasts, Facebook pages, and they even have a mobile app, IRS to go. I have no idea who would feel the need to have the IRS to go mobile app. But if that's you, certainly, post to the general discussion board. I'd love to know how you use that. Bundled with your book is the Intuit's Pro Connect Tax Online. This is commercial tax prep software, which we will not be using as part of this course. But if you have a desire to use this and just play around with it, you're certainly free to do that. It's certainly of the same quality that a tax professional would be using out in the community. And there are other Intuit clearly has got a stake in this book because the author is pumping the Pro Connect, the little Cert, and the TurboTax, which are all Intuit products. But Intuit is by no means the only software provider of commercial tax products. I do not happen to use the Intuit products myself. I use something by another provider. TurboTax, many of you may use. It's a fairly common consumer friendly site that many of my clients use to prepare their own taxes. And most of the taxes these days are done electronically. Very rarely do I find someone who is insistent on filing a paper tax return, although it does happen. And there are some instances where paper returns are required, but by and large, most professional preparers are obligated to file a return electronically, and the only time you can't file it, you have to basically justify why you're filing it in paper. And I suspect that, as we roll on at some point, they may eliminate the ability to file in paper, who knows. But that concludes chapter 1. And so good luck on the homework, and I look forward to any questions on the general discussion board or chatting with you on our topic for this week.